Finance means the funds or money required by a business enterprise to start, expand, and diversify to produce high-quality goods and meet day-to-day expenses. The survival of a business in the highly competitive market entirely depends on the conscience of financial manager how efficiently he utilizes the funds. We can say that business finance is the lifeline of an organization. Let us discuss business finance, financial management, financial decisions, financial planning, capital structure, management of fixed capital, and management of working capital. Business finance. Money required to run any business organization is known as business finance. Creation of organizational structure would serve no purpose unless finance is arranged to run all divisions and departments. Business finance is required for the acquisition of tangible assets like land, building, plant, machinery, furniture, etc., and intangible assets like goodwill, patents, trademarks, copyrights, etc. Financial management. Financial management is concerned with the estimation of funds required to be invested in the non-current assets and current assets, identification of sources of long-term funds, that is, equity share capital, preference share capital, and debt for procuring non-current assets and short-term funds, that is, cash, bank, short-term loans, etc. for procuring current assets. Distribution of the earning among the equity shareholders. Role of financial management. The common activities and the areas which are influenced by financial management are size and composition of fixed assets, size and composition of current assets, sources of long-term and short-term financing, fixing debt-equity ratio in capital employed, and items in the P&L account. Objectives of financial management. The objectives of financial management are as follows. A. To ensure regular and adequate supply of funds to the concern. B. To ensure adequate returns to the shareholders. C. To ensure optimum funds utilization. D. To ensure safety on investment. E. To plan a sound capital structure. Financial decisions. The decision relating how to raise the funds, where to invest, and utilization of the earning on the investments are known as financial decisions. Financial decisions relate to the management of finance, and the management of finance is based on three broad decisions: investment decision, financing decision, and dividend decision. Investment decision. This decision relates to the careful selection of assets in which funds will be invested by the firm. The decisions may relate to investment in assets which may be long-term or short-term in nature. It involves huge amount, and such decisions must be taken after careful comparison of various alternatives available, such as where to invest. Financing decision. The business has to decide the ratio of borrowed funds and owned funds. The main concern of the finance manager is to decide how much amount is to be raised from owners' funds and how much is to be raised from borrowed funds. Dividend decision. Dividend decision. The business has to decide how much profits to distribute as dividends and how much to retain for investment. Therefore, if a company has investment opportunities, it will have to declare low rate of dividend, and if the company has no future financial requirements, it can afford to declare higher rate of dividend to equity shareholders. Factors affecting investment decisions. These include cash flow of the project, the rate of return, and investment criteria involved. Factors affecting financing decisions. These include cost, risk, cash flow position, control considerations, flotation costs, fixed operating cost, and state of capital market. Factors affecting dividend decisions. These include amount of earnings, stability of dividend, stability of earnings, growth opportunities, cash flow position, preference of shareholders, taxation policy, stock market reactions, and access to capital market considerations. Financial risk. Financial risk may be defined as an obligation of interest payment on debt consisting of debentures, bonds, long-term loans, whether secured or unsecured, and repayment of debt. It arises because interest is charged against the profits and has to be paid under all circumstances, and repayment of the debt is necessary within the time period for which the debt has been raised. Financial planning. Financial planning relates to the estimation of funds required to be invested in fixed assets and current assets, raising long-term funds by issuing shares, debentures, and raising loans for the purchase of fixed assets, raising short-term funds for procuring current assets, and taking decisions relating to distribution of profit by the way of dividend and retaining profits for future investments. Importance of financial planning. It facilitates collection of optimum funds. It helps in fixing the most appropriate capital structure. It helps in investing finance in right projects. It helps in operational activities. It reduces financial uncertainties. Base for financial control. And it helps in proper utilization of finance. Capital structure. Capital structure means the proportion of debt and equity used for financing the operations of business. It represents the proportion of debt and equity in the capital employed. It increases the value of equity share or maximizes the wealth of equity shareholders. Factors determining the capital structure. These include cash flow position, interest coverage ratio, debt service coverage ratio, return on investment, cost of debt, tax rate, cost of equity, flotation costs, control, flexibility, stock market conditions, and government regulations. Difference between capitalization and capital structure. Management of fixed capital. Management of fixed capital means the sum of fixed assets required by an organization and their sources of funds in the form of equity shares, preference shares, debentures, and long-term loans. These decisions are also called capital budgeting decisions or fixed capital decisions or investment decisions. Importance of fixed capital management. Long-term growth. Large amount of funds involved. Risk involved. Irreversible decision. Factors determining investment decisions. These include nature of business, scale of operation, choice of technique, technology upgradation, growth prospects, diversification, financing alternatives, and level of collaboration. Management of working capital. Concept of working capital. For the purpose of producing goods, we need fixed assets, but to produce goods for maintaining an operating cycle, the capital we need is known as working capital. It is financed through short-term funds. Meaning of working capital. Working capital refers to the difference between the sum of short-term assets of the firm, such as cash, bank, trade receivables, etc., and sum of short-term liabilities, such as creditors, bill payable, etc. There are two concepts of working capital: gross working capital and net working capital. Factors determining working capital. These include nature of business, scale of operation, business cycle fluctuations, seasonal factors, length of operating production cycle, credit allowed to debtors, availability of raw materials, production and technology, operating efficiency, growth prospects, level of completion, and inflation.